Welcome back, investors. We are analyzing the Walt Disney Company today. Thanks to the suggestion by Toasty. He was my first subscriber and has been pretty active in the comments for me, which is great to get some feedback. If only one person finds this channel and appreciates it, that's good enough for me. This is kind of just a passion project of mine. The channel is called The Value Formula. Just really interested in value investing and stock analysis. I'm an accountant full time. I've got my MBA concentrated in finance, and it's really taught me a lot. And so that's something that I like to use. Now, I don't use that full time because I'm an accountant. I'm mostly focused on numbers and stuff, but I really like the qualitative analysis of companies along with the quantitative analysis. And so we're looking at Disney. They fall within the entertainment industry, but their sector that they fall into is typically looked at as communication services. They're kind of hard to compare to a lot of other companies out there because they're not just like the physical entertainment, and they're not just the streaming and visual entertainment. And so they're kind of hard to compare. And really the companies that they end up competing with on different fronts also tend to be kind of diversified. And so we're going to see that here towards the end. But to start with, I've got a couple items where we can kind of see how Disney compares to the industry. And so let's jump in. So current price today is $92. Our ISS governance scores, both, all four look pretty good. The highest one being audit, and I've got a comment on what the auditors noted in this year's annual report. That annual report, 10K, came out at their fiscal year end, which is back in October. So we won't get to see really up-to-date outlook and discussion from them about their company until October of this year. Of course, we can look at those quarterly reports, but I don't feel like they really give as tight of a picture as the annual report does, because it has to include all the quarters. So as we're looking through this, some of those key ratios for fundamental analysis, our earnings per share is pretty much on track with the industry, 2.25. The trailing PE, 40.96, pretty bloated, and so a little overvalued there. Of course, so some of these industry scores that I found were from Fidelity stock screeners. If you have like an IRA or an investing brokerage account with them, you get a lot of really cool screeners and stock information. And so I was incorporating some more of that in this one, though I typically just pull from Yahoo Finance because I don't have to log in or anything. And so it showed 1,248.37 for trailing PE in that industry. So, I mean, not really a good thing to compare to because it's not specific enough. The forward PE for Disney looks like it's at 16.18. So I think there's some mixed sentiment on the company right now, which we'll see. There's a lot of noteworthy stuff to consider about Disney, and so we'll dive into that. But looks like they might start trading at more of a discount for the type of business that they have. I know there's a lot of different situational changes, but really the underlying business is mostly the same. Our PEG ratio, that's price earnings to growth, is at 0.75. We always like to see less than 1. And so 0.75 is pretty good, honestly. So that tells me that, again, there might be some value here. Our price per book is 1.72, so less than 2-ish. I like to see around 1.5 or under 1 really is ideal, but 1.72 is not bad. Book value per share is at 54.13. And again, I need to be double checking these. I'm not sure if if that's just the tangible book value per share. Hopefully it is, because a lot of their assets on their books are intangible. Their price per sales is 1.94. Not terrible. Again, you really would like to see less than 1 on a price per sales. Profit margin, operating margin, fairly slim. We're not in those double digits, but around 5% and 8.5% aren't horrible. They're making some money. They're not losing all of your invested capital, so that's a good thing. On return on assets and equity, that's a measure of management performance, and so it's a little behind on assets, but well ahead on equity compared to the industry. So that's a really good positive. And on these 4 percentages, again, it looks at management effectiveness. Well, as we'll know, they had a big management shakeup last November. So, it'll be interesting to see how those numbers change over the next few quarters, over the next year, since, that's based on management's ability to run the company. And I think they are in better hands now. Past 5-year growth was negative 18%. And, if you can look at a comparison between Disney and the S&P 500 from the last 5 years, Disney just took a dive, really did not hold up compared to the bigger index. And that's a challenge, right? If you're trying to pick individual companies, there's a good, really high chance you're going to miss out on just the standard growth that you would see just investing in an index fund. So for most people, and that includes people who might be watching this, maybe an index fund is a better option for you. I would only invest money in individual stocks if it's money you can afford to lose. But again, that is for every investor to just decide for themselves. Their next 5-year growth is projected to be around 22%, which is really solid. And I don't know if that's an annual growth or, compounded average, but 21.87 is not a bad return. And, of course, with that, it's just expected. It's, however many analysts looked at the company and said, we think it'll grow this much. Well, we don't know what's going to happen in the next few years. And again, with all the just challenges right now, in the business environment, especially in the United States, it's going to be interesting to see what happens over the next few months, let alone the next couple years. On our operating cash flow and levered free cash flow, both of those look good. So, not super concerned there. Definitely like to see a lot higher numbers for a company this size, but, they've got cash flow on hand. Their current ratio is only at basically right at a 1, which I really don't like to see that. I want to see a company operating at least 2, if not 2.5, on their current ratio. But, at least, they're liquid, I guess. The quick ratio, 0.94. That's your current assets minus your inventory divided by your current liabilities. So on the acid test, it does all right. If they can't sell all their inventory, they can at least turn around and pay those current liabilities. So that's a good thing. Debt to equity is not in a bad spot, 43.96. We were looking at a couple companies 2 videos ago that had, multiple hundreds on that score. So definitely doing good. The industry runs about 42.7. So a little higher than the industry, but right on track. They don't pay a dividend, so nothing really to go in that information. And that's kind of a drawback for me. Part of why I haven't really analyzed them too in depth before, or really spent a lot of time looking at them is, I do like getting dividends. It's just, everybody's got their own opinions on that, but I feel like as a shareholder, I have a right to at least a portion of the profits. And so I think it is a good thing for a company to be returning some of that value on top of investing the rest of the profit back in the business. On insider ownership, 0.06%, a really tiny percent compared to some of the other companies we've looked at, but There is insider ownership listed, so that's always nice. Couldn't really put a lot on market share because, again, Disney operates in kind of weird segments. And of course, they don't, in their annual report, they're not listing what their market share is on those segments. And so, Ford and GM, they list their market share in their annual reports. Disney does not. I included this little image from Yahoo Finance, just kind of looking at Disney versus that communication services sector. Way ahead in innovation and hiring, way ahead in earnings. A little challenged in terms of dividends and sustainability, along with insider sentiment is right on track. So we're getting into this kind of noteworthy section. This is where I put a lot of our qualitative analysis, just looking at the dynamics of the business and things to consider about it, interesting things that I caught in the annual report, those kinds of things. So one of the interesting things is Disney actually owns a huge percentage of Hulu. They, I think, recently started putting some of that content on Disney Plus, but Comcast owns the other, 30% or so of it, and they're trying to look at Disney acquiring all of that. I'm not sure where they're at in that. I was looking at some news articles. It looks like they're projecting early 2024 for Disney to end up with all of Hulu in their hands, in which case, that could bring in a lot of people for their streaming business, but we'll see. If you look at just Google Disney, 90% of news, even in investment sources, is about their ongoing feud with Ron DeSantis, the governor of Florida. Started a while back with the sexual rights bill, and just really a challenging thing. Even with that litigation, I think I note that in here somewhere, but in their annual report under litigation, they know, oh yeah, there's some different things going on, but we're unconcerned with that litigation on a material basis. That's in that third column, second row there. They don't expect it to impact their business money-wise on a significant level. So I thought that was kind of interesting. Granted, in their in the risk factors section on that 10K, they do talk a lot about changing consumer sentiment or failing to meet, the interests and keep their viewers and consumers, satisfied. So, I think this does have some level. It not necessarily in legal fees and stuff, but it could impact sales depending on what that public sentiment is. And this is something we've been seeing a lot. There's a lot of articles right now about social issues and companies and how they should handle these things. And, it goes multiple ways. It does on some level affect your business, though. And, we've seen with Anheuser-Busch and Target and some of these other companies that, depending on where sentiment is at in certain regions, that can affect sales, it can affect revenues. And so definitely not something you want, but that's kind of the unique situation we're in currently. Something for companies to be thinking about. Recently, partially due to this ongoing feud, they decided they were going to scrap $1 billion campus that would have brought in 2,000 jobs to the area. They're scrapping the $864 million Lake Nona corporate campus, so not moving their executives out there. So again, that would have been a lot of investment into the Florida economy, but a lot of that's drying up now. And part of that as well could just be cost-cutting measures. Something, right there, axing titles and jobs, multi-billion-dollar cost-cutting. The previous CEO kind of started that with a layoff of 7,000 employees, and I think that's just kind of going on. A lot of companies just trying to get leaner and meaner. They closed down their Star Wars hotel at Walt Disney World. From what I read, it just was really, really expensive, and a lot of people just weren't really, even the diehard Star Wars fans weren't going to drop, thousands of dollars to go stay there. But it did look pretty cool. Really recent news, Apple unveiled their Vision Pro headset the other day, and surprisingly, along with Tim Cook, Bob Iger, forgive me for however I mispronounced that, but he actually appeared on stage, and they basically announced their partnership that Disney Plus is going to be available day one on those headsets. I don't know what those sales are going to look like. It's got a hefty price tag at $3,500. Not something I'm going to be shelling out money for, but, good thing for Disney that they're showing up there with some of these other big companies. Let's see. Interesting how many brands they own. Not a lot of people know they own ESPN, ABC, most of Hulu. They own most of A&E, FX. I mean, tons of company, and we'll see that on that graphic down below. You may not know this, but the CEO, Bob Chapek, again, I'm not good at pronouncing words. He was kicked out last year. He had like 3 more years on his contract, and they basically decided that it wasn't going well, and they booted him. Granted, the guy didn't really have a good chance to do well. Disney had the same CEO, Bob Iger, since 2005, so 15 years, and, this new guy shows up, and then coronavirus hits, which really is, big decline in profits and profitability of the company, and it looked bad on him, but also you're going to get compared to the guy before you, and unfortunately Bob did not measure up to Bob, so that was unfortunate for him, but it could be a good thing for the company moving forward. I believe he said, Eager said that he's only going to stay on for like 2 years, and so hopefully they can do a little better succession planning to get the next guy in and for that person to be successful. And of course, part of the reason that oust happened was last year they noted that they had a $1.5 billion loss on Disney Plus, which not good. So one of the cool things about Disney, part of what makes them unique, is just the fan bases and beloved brands that they own. You got Marvel, Star Wars, Disney, and a slew of others that people are die-hard fans for. I mean, there's so many licensing opportunities for these. I could do without all of the spinoffs, but I mean, they're involved in world building and stuff that, honestly, those fandoms are going to endure. They've endured for this long, and I assume they will continue to. So definitely some ability to monetize there. Of course, you want to continue to build brands, and so their creativity is definitely going to have to continue. One of the things I found interesting was just how transparent they are on compensation. They lay it all out there as far as how their executives are paid and the incentives. And it was interesting on the CEO how little of his compensation was just base salary. Like 4%, I think, of his salary, of his compensation is base salary. Let's see, I'm going to jump up. So the audit report, the issue that it noted was amortization of production costs, whether they were doing it as singular units or group units, which mostly just has to do with some of those intangible factors. Again, unconcerned with litigation. One of the issues that Disney's really going to start grappling with over the next probably decade is copyright law. We saw, I think it was last year, maybe year before, Winnie the Pooh, the copyright on Winnie the Pooh expired, and so he became public domain. Now, that's a problem for a company that has copyright rights to certain characters, the image, the use of those to make money off them. Of course, it's not Winnie the Pooh with the red shirt, it's just the naked Winnie the Pooh, so they've got a little time there. I really liked on like the second or third page of the report, they were talking about some of their key values, and one of the programs they have is called Disney Aspire. That's a long-term career investment in hourly employees. I think Disney does a very good job of investing in the people that work for the company. That's good long-term for a company. It has to be a little bit beyond just driving profit. I think it was Jack Bogle with GE years ago. just made it a profit driving machine. And just, it's all about performance, and that pushed for a couple decades there. But ultimately, it long term, it's not a healthy way to really run a business. I think we see that with GE, that it basically became this giant conglomerate and then had to spin everything off and really got close to bankruptcy, or actually went bankrupt. I don't know. Anyway, so that's a big deal, I think. I noticed that half of the total assets on their balance sheet are goodwill and intangible assets. So yeah, it looks like they have a lot of assets on the balance sheet, but like $100 billion worth of that aren't tangible, real things. And so, like I said, on the copyright law, that's something they have to worry about, because that's going to impair those intangible assets. A high amount of goodwill shows that they might be overpaying in their acquisitions, and so they really need to get a strong rate of return on those, which we've seen. Like they've got a mixed history on that. I like that I saw that about $10 billion per year is spent on capital expenditures and debt repayment. It's like $5 billion and $5 billion, give or take, almost every year that they're spending towards, investing back into their business or paying down, the debt that they owe. So that's a healthy thing you want to see in a company that has positive cash flows afterwards. Disney notes in their annual report they're split into two segments that they earn their profits from. There's DMED, which is marketing, entertainment, side of things. They operate in linear networks, directed to consumer content sales and licensing. So the revenues that come from that are through affiliates, subscriptions, advertising, television contracts, theatrical releases, home entertainment, and then other revenues. The expenses related to that are their studios, the general entertainment, sports, and the high licensing on those can be challenging with the ESPN network, selling, general and administrative, and then international, as well as depreciation and amortization. The other side, so you have DMED, you have DPEP, which is their parks and experiences. That, the two big segments there, parks and experiences and consumer products. They get their revenues from theme park admissions, merch, food, and beverage, resorts and vacations, merchandise licensing, retail, park licensing, and then their expenses would come out of operating. So your labor, cost of goods sold, infrastructure, supplies, commissions, entertainment offerings, depreciation and amortization, and then more capital investments. So, pretty balanced there. Again, I think that's what makes Disney hard to compare to others, is that they have both the entertainment side and the parks and experiences along with product side. Two very different things, but I think they work really well together for Disney to make a lot of money. Their top competitors, and you can kind of see some of this down here in that graphic, which we'll get to in a second. Top competitors are like News Corp, Paramount, Netflix, Warner Brothers, Apple, Amazon. And some of these companies are just, they're just entertainment streaming type companies. News Corp, Paramount, Netflix, Warner Brothers Discovery. So, those lack that parks/experience side of things. And then you have like Apple and Amazon, where, you've got Apple TV, you've got Amazon Prime. They compete on the streaming side, but Apple's, it's a consumer, information technology, focused on, like phone sales and stuff company. So hard to compare to Disney, which has so much set up in their intangible asset side of things. And then Amazon, they've got their streaming services, but most of their money for their company comes from AWS, not even necessarily from their online store segment, which is that consumer discretionary. So it's kind of interesting that, Amazon's listed as a consumer discretionary because they operate so much on the software side of things. And so, you got mostly communication services comparisons, but also, they find themselves in a weird balance there. Again, I found this graphic online. So looking at some of these big competitors, Disney, Comcast, WBD, and Paramount, You can see some of the kind of partnerships there, like Hulu, as well as some others, and just the number of brands that are out there, the cost per month, those kinds of things. And then again, also Netflix, Amazon, Apple TV, and then you've also got some of these other networks: Sony, Lionsgate, Amblin, AMC Networks, and Fox. All of these are kind of running against each other, and so creates a really dynamic market. So, I mean, hopefully you got a lot of value out of this video. If you have questions, if I said something wrong and I need to be corrected, drop some comments down there. Help me out. I really appreciate feedback and being able to make these videos better, so that you're getting some value out of this. While you're at it, if you'll like and subscribe to my channel, I really appreciate that as well. That just helps you to ensure that when these videos come out, when I get things wrong, you're right there to correct me. Again, that's something I really appreciate, and hopefully we can grow together. I can get even better at this, and we can be successful together. So y'all have a great day. Hopefully this has been informative, and I will see you next time.